2008, millions of Americans lost their homes, their savings, and their retirement accounts. It looked like the world was getting poorer, but behind the scenes, some of the richest investors in history were buying. Warren Buffett invested billions. David Tepper bought collapsing banks. Blackstone quietly bought thousands of foreclosed homes. When the panic was over, they weren't just richer, they were wealthier than ever. So here's the question. Nobody asks, what if market crashes don't destroy wealth? What if they simply transfer it from those who panic to those who are prepared? Because when you study every major market crash, from 1929 to 2008 to 2020, you discover the exact same pattern, and once you see it, you'll never look at another market crash the same way again. Hi, I'm Gavin. If you enjoy videos about money and investing, consider liking and subscribing. By the end of this video, you'll understand why the rich get richer during every market crash, and how you can avoid the mistakes that keep everyone else behind. Let's dive in. The hidden rule. Every market crash follows. Imagine two investors. Both own the exact same portfolio. Both watch the market fall 10%, then 20%, then 30%. One investor sees disaster. The other sees opportunity. A few years later, one is still trying to recover. The other has doubled his wealth. So what changed? The market? No. Both experienced the exact same crash. The difference was their decision. And that's the hidden rule almost every market crash follows. The crash itself doesn't decide who becomes wealthy. It simply reveals who was prepared. History proves this again and again. In 1929, panic selling wiped out fortunes almost overnight. In 1987, investors watched the market suffer its worst single-day collapse in history. In 2000, the dot-com bubble erased trillions of dollars. In 2008, the financial system itself appeared to be collapsing. In 2020, the fastest bear market in modern history convinced millions that another Great Depression had begun. Different decades, different causes, different headlines, but every crash followed the same pattern. Fear spread, people sold, prices collapsed, and then something remarkable happened. Long before the headlines became optimistic again, long before economists declared the crisis was over, someone was buying. Not because they knew the exact bottom, not because they could predict the future, but because they understood something that most people didn't. A falling price doesn't always mean a falling value. Sometimes, it simply means fear has become more powerful than logic. And when that happens, extraordinary opportunities begin to appear. But if that's true, why do millions of intelligent people continue making the exact same mistake in every single crash? The answer has nothing to do with the stock market. It has everything to do with the human brain. Your brain is working against you. Here's the uncomfortable truth. Most people don't lose money during market crashes because they're bad investors. They lose money because they're human. Imagine waking up one morning, checking your portfolio, and seeing it's down 15%. You tell yourself, it's fine, it'll recover. Then, the next day, it's down another 10%. The news flashes across your TV. Markets are in free fall. Experts warn of a recession. Billions wiped out in a single day. Your phone starts buzzing. Friends are selling. Social media is filled with predictions that this is just the beginning. And suddenly, you're no longer thinking logically. You're simply trying to stop the pain. Psychologists call this loss aversion. Research has shown that losing money hurts about twice as much as making the same amount feels good. That's why even experienced investors can make emotional decisions during market crashes. But that's only half the story. The second trap is even more dangerous. It's called herd mentality. When everyone around us is running, our brain assumes they must know something we don't. So we run too. Not because we've analyzed the situation, but because following the crowd feels safer than standing alone. Ironically, the crowd is usually running in the wrong direction. History shows that many investors sell near the bottom, exactly when fear is at its highest. Then, they wait for good news before buying back in. By then, the biggest gains have already happened. One famous study found that missing just the 30 best days in the market over a 20-year period reduced a $10,000 investment to around $11,000 instead of growing to more than $63,000. Think about that. Just 30 days out of thousands of trading days made the difference between building wealth and barely growing your money at all. And here's the cruel twist. Many of those best days happened immediately after major market crashes, when fear was still everywhere. That's why the stock market isn't just a test of intelligence. It's a test of emotional control. Because while millions of investors are fighting the market, the world's best investors are fighting something else. Their own emotions. And once they've mastered that, the market becomes much easier to understand. But that still leaves one important question. What actually happens inside the market while everyone is panicking? Because behind the falling prices, an invisible chain reaction has already begun. What really happens during a market crash? At first, a market crash looks simple. Prices fall. People panic. Money disappears. But that's not what's actually happening. Behind every major crash, a chain reaction quietly begins. It usually starts with a single event. A housing bubble bursts, a pandemic shuts down the world, interest rates rise, or a major company suddenly fails. At first, only a few investors sell. Then prices begin to fall. More people notice, more people panic, more people sell. But this is where things spiral out of control. Many investors don't invest using only their own money. They borrow money from their broker to buy even more stocks. This is called margin. When markets are rising, it can make investors look like geniuses. But when prices fall, it becomes a disaster. As losses grow, brokers demand more money to cover those positions. If investors can't pay, their stocks are automatically sold, not because they want to sell, but because they have no choice. And every forced sale pushes prices even lower, which triggers even more margin calls, which creates even more selling. It's like knocking over the first domino. Once it starts, the entire chain begins to fall, but that's not the only force driving prices down. Today, trillions of dollars are invested through index funds and ETFs. When frightened investors pull their money out, those funds are forced to sell the underlying stocks. That means even strong, profitable companies can see their share prices collapse. Not because the business is failing, but because fear is spreading faster than facts. This is the moment where price and value begin to separate. A great business can suddenly become 30, 40, even 50% cheaper, while the business itself hasn't changed very much. And that's exactly the moment long-term investors wait for, because while the crowd sees falling prices, they see discounted ownership. The average investor believes the market is becoming more dangerous. The wealthy believe great businesses are becoming cheaper. Same market, same crash, completely different perspective. And that's why the biggest fortunes aren't usually built after the recovery begins. They're built while everyone else is still afraid. So the real question isn't, what are billionaires buying? It's, why are they so calm when everyone else is panicking? Because the answer has very little to do with money, and everything to do with how they think. The Billionaire Playbook. So what separates someone who panics during a market crash from someone who builds a fortune? It's not a higher IQ. It's not insider information, and it's definitely not luck. It's preparation. While most people spend bull markets celebrating rising prices, the world's greatest investors spend them preparing for falling ones. Take Warren Buffett. He once said to be fearful when others are greedy, and greedy when others are fearful. That sounds simple. Until the market crashes 40%, because that's when those words are truly tested. During the 2008 financial crisis, while investors were rushing to sell, Buffett was deploying billions of dollars into companies like Goldman Sachs and Bank of America. He wasn't buying because he knew the exact bottom. He was buying because great businesses were suddenly trading at extraordinary prices. David Tepper followed a similar strategy. As fear spread across Wall Street, he aggressively bought beaten-down bank stocks that almost nobody wanted. Those investments later generated billions of dollars in profits as the financial system recovered. Howard Marks sees crashes differently too. He compares investing to buying your favorite food. When it goes on sale, you don't stop buying it. You buy more. To him, market crashes are simply moments when great assets go on sale. But here's what all of these investors have in common. They don't wait for a crash to prepare. They prepare before the crash ever happens. They keep cash available, they avoid taking excessive risk, and most importantly, they don't let emotions make financial decisions, because they understand something most investors never do. You don't make your money when the headlines finally become optimistic. You make it when everyone else is too afraid to act. That's why Charlie Munger once said that waiting is one of an investor's greatest advantages, because most people simply can't do it. The average investor waits for confidence before buying. The billionaire waits for value. And that's why, by the time the public feels comfortable investing again, the biggest opportunities have already disappeared. But billionaires aren't the only ones taking advantage of market crashes. Behind the scenes, some of the world's largest financial institutions are making their biggest moves of all. The greatest wealth transfer in every market crash. Here's the part almost nobody talks about. When a market crashes, most people think wealth simply disappears. But wealth doesn't just vanish, it changes hands. Think about it. When someone panic sells a stock, someone else is buying it. When a family loses their home to foreclosure, someone else becomes the new owner. When a struggling business runs out of cash, someone eventually buys its assets. A market crash isn't just destroying wealth, it's transferring ownership. And the people doing the buying are usually the ones who prepared long before the crisis began. The 2008 financial crisis is one of the clearest examples. Millions of American families lost their homes. For many, it meant losing the largest asset they would ever own. But while ordinary families were being forced to sell, Wall Street saw an opportunity. Investment firms began buying foreclosed homes by the thousands. Blackstone alone spent billions acquiring roughly 40,000 single-family homes, transforming them into one of the largest rental portfolios in the United States. Think about what that really means. One family's financial tragedy became another investor's long-term asset, and it wasn't just housing. Private equity firms bought struggling companies. Hedge funds purchased distressed debt for pennies on the dollar. Large corporations acquired competitors that suddenly couldn't survive on their own. While headlines focused on the crisis, institutions were quietly building the next decade of wealth. This is why the richest investors don't spend every day trying to predict the next crash. Instead, they prepare for it. Private equity firms keep enormous amounts of cash waiting for moments exactly like these. The industry even has a name for it: dry powder. Capital that's intentionally kept on the sidelines, waiting for fear to create opportunity. And that's the difference. The average investor asks, "How do I survive this?" The institution asks, "How much can we buy before prices recover?" That's why every major market crash quietly widens the gap between those who own assets and those who are forced to give them up. But if history has repeated this pattern for nearly a century, why do millions of investors still make the same decisions every time? The answer isn't hidden inside the stock market. It's hidden in the stories people hear every single day. Because during a market crash, fear doesn't spread through prices first. It spreads through headlines. The numbers don't lie. By now, you might be wondering, is this really a pattern, or just a few lucky examples? The data gives us a very clear answer. Over the last century, the U.S. stock market has been through wars, financial crises, oil shocks, a global pandemic, and dozens of bear markets. Yet every single one eventually recovered and reached new all-time highs. Now here's a statistic that completely changed the way I think about investing. Imagine two people. Both invest $10,000. One stays invested through every crash. The other panics and misses just the 30 best trading days over the next 20 years. You'd expect a small difference, but the reality is shocking. The investor who stayed in the market ended up with around $63,000. The investor who missed those 30 days finished with just $11,000. Think about that. Out of more than 5,000 trading days, missing just 30 changed the outcome completely. And here's the part most people never realize. Many of those best days happened during bear markets. or immediately after them, when fear was at its highest. That's why panic selling is so dangerous. It doesn't just lock in your losses, it often causes you to miss the recovery that creates long-term wealth. History also tells us something equally important. Bear markets are temporary. Bull markets last much longer. On average, bear markets decline by around 35% and last about a year. But eventually, they recover. Every single time. So maybe the biggest risk isn't experiencing a market crash. Maybe it's letting fear convince you that this time, history won't repeat itself. Because that's exactly what millions of investors have believed, before every major recovery. And that belief has cost them billions. So why do so many intelligent people continue making the same mistake, generation after generation? Because during every market crash, there's one force that's even more powerful than fear itself. The media. The media trap. Now here's something worth thinking about. If history shows that markets eventually recover, why do millions of investors still panic every single time? Because most people don't experience a market crash through charts. They experience it through headlines. Markets in free fall. Billions wiped out. Worst crash since 2008. Is this the next Great Depression? During a market crash, those headlines are everywhere. On TV, on your phone, across social media, and after seeing them enough times, your brain starts believing one dangerous idea. This time is different. But here's the problem. The media isn't trying to predict the future. It's trying to capture your attention. And nothing captures attention like fear. The more uncertainty people feel, the more they watch, the more they click, the more they share. Fear spreads faster than facts, and that's exactly what happened in 2008. It happened again during the COVID crash, and it will likely happen during the next major downturn too. Meanwhile, while everyone else is glued to frightening headlines, professional investors are focused on something entirely different. They're reading earnings reports, studying balance sheets, calculating intrinsic value. They're asking one simple question. Has the price fallen more than the business is actually worth? Because if the answer is yes, a market crash becomes an opportunity. That's the biggest difference between the crowd and the professionals. The crowd reacts to headlines, professionals react to value, and history suggests that one approach builds anxiety, while the other builds wealth. So the next time the market crashes, don't just pay attention to what people are saying, pay attention to what the smartest investors are doing. Because actions tell a much more important story than headlines ever will. And after looking at nearly a century of market history, one lesson stands above all the rest. The final lesson. So, why do the rich get richer during every market crash? Not because they can predict the future, but because they prepare for it. While most people panic, they stay patient. While others focus on fear, they focus on value. And that's the pattern history has repeated for nearly a century. Every market crash is a test, not of your money, but of your mindset. Because when prices fall, most people see risk. A few see opportunity. And that single difference has quietly created some of the greatest fortunes in history. The next market crash will come. No one knows when. But one thing is almost certain. Millions will panic. And a small group will quietly begin buying. The only question is, which group will you belong to? If you enjoyed this deep dive, don't forget to like the video and subscribe to Gavin Invests for more videos on money, investing, and the financial decisions that shape your future. Thanks for watching, and I'll see you in the next one.